Friends, I am very happy to present to you the second product of ithoughtPMS. The curation of a product is a very exciting and challenging experience. Who we create this product for, how it will address a need, and the manner in which the investment experience will work out. These are the three principal questions which we always address before we launch a product. When we create a product, it is very easy to create products based on trends, but those products do not sustainably deliver. So when we create a product, it is very important to create a product that stands the test of time. Only if a product can stand the test of time, it will address the investment need of a large cross-section of investors. Why do investors want a PMS? They want a PMS principally to address their need to invest in good businesses for sustainable periods of time to create sensible returns. Most products in the market have that intent and deliver on that intent. But the curation of a product should also give the investor the right experience. While the product would have sustainably delivered returns for a few, it could still not deliver sustainable returns for the majority, especially those who enter late. Timing in PMS tends to distort investment experience of greater number of investors. So when we create a product and ask ourselves the question, who do we create this product for? I would say we create this product for people who enter at any point in time. Whether you enter in a bull market or a bear market, it is important that the product is curated in a way in which it works for everybody. How will the product address the need? For every investor, people who join at any point in time. First, the product should deliver a more uniform investment experience. This is never going to be easy, but there still is a need to try our very best to improve on this. That is what we are going to try in this product. The sustained experience will happen by making the investor believe in the product, making him stay invested, managing his anxiety better, ensuring that he makes the journey very, very comfortable. So, I'm very happy to present to you ithoughtCOIN, our second PMS offering. This product is an idea which came to us from the investment experiences of investors over the last 3 years. Managed portfolios are struggling to meet even the investment performance of the benchmarks. There is a growing belief that passive investing is superior to active investing, while we believe that there can be a superior active investing approach that replicates the benefits of passive investing. That in essence is ithoughtCOIN. So what are we going to do in ithoughtCOIN? The first objective of COIN is to be investing in high quality businesses at the price of a passive fund. Actually, COIN to begin with is cheaper than even a passive fund. Importantly, we have brought in performance as the driver. So, while the product has the advantages of a passive fund, It derives from the investment universe of a passive fund. It generates returns and then compensates the fund manager. So in that sense, COIN is a fresh idea in a space where you have multiple options. The freshness comes from how this product is curated. Here we go. As I told you, the space is beaten. COIN is going to restrict itself to NIFTY. For us, the portfolio will be within the NIFTY. You may wonder, why should I come to COIN? Why can't I go to an index fund? The reasons are simple. When you buy NIFTY as an index fund, you buy the performing businesses and the non-performing businesses. You end up owning companies in the NIFTY which you don't want to own, you don't need to own, or which may not be worth owning as well. On the contrary, it is only a smaller subset of companies within the NIFTY which deliver NIFTY's performance. COIN proposes to own only this subset. So, you will own all the companies that deliver performance in the NIFTY, and you will avoid the businesses within the NIFTY which you should not own or you don't want to own. The NIFTY has performed significantly in the last few years, as this chart shows you, but passive investing may not work at all times. So, there is a need to own better businesses even within an index, and there is a need not to own the weaker investments in the index. I'll give you a simple example. You are aware that twice a year companies are knocked off from the NIFTY and new companies come in. Why do they do this? Because they see a need to eliminate non-performers and give space for performers. This is precisely what COIN will do on a running basis. So effectively, while NIFTY kicks out a company like a Yes Bank after the bank has destroyed the value, here we will not even own it. So that in essence is how COIN will eliminate the negativity within the NIFTY in your portfolio. As I told you, NIFTY stocks behave very differently from the NIFTY. As this slide shows you, only 9 NIFTY companies have outperformed NIFTY by 3% over the last 10 years, right? That's a very interesting statistic. And here's the next one. Only 2 NIFTY stocks outperformed the NIFTY 100% of the time on a 3-year rolling basis. Here is another statistic. Only 3 NIFTY stocks never had a drawdown of more than 30% from its all-time high. Lastly, 24 out of 50 NIFTY stocks have created a new all-time high in over 6 out of 10 years. That's a new peak once in every 2 years. So, while NIFTY tends to perform decently, that performance comes from superior performance of a few companies within the NIFTY. It's very important to own those companies, and it's doubly more important not to own the weaker companies within the NIFTY. I'm sure you got the logic of that. Now to the most important question on the investor's mind. Why should I do active investing? Why can't I be just a passive investor? The diminishing returns in large cap funds has been a growing source of worry. We are seeing it in both PMSs and large cap mutual funds. We have observed that the funds are not beating the benchmark or struggling to beat the benchmark. On the contrary, the benchmark is performing very well. So, the argument is naturally growing that why should I take all the trouble? The reason you should take trouble is that the rewards for taking the trouble are significant. For example, if you don't own the companies which are not worth owning in the NIFTY, if you avoid owning the companies that eventually drop out from the NIFTY, and if you stick to the better companies within the NIFTY, By allocating more money to the performing companies, it is very natural for you to beat the Nifty. And it is natural for your performance to be superior. More importantly, I come to the third point I mentioned. Your investment experience through the journey will be way superior to even passive investing. And that in essence is why active investing done in a positive way with the right governance, with good investment management, sticking to valuation, taking advantage of the market's inconsistencies, buying into mispricing of the great businesses when Mr. Market throws them at you, will always significantly beat passive investing. I won't go into the question of why active managers are failing to do it, but I will stop by saying this. It is certainly possible for a pragmatic manager to do it. The reason it doesn't happen probably is because people are fully invested. By waiting and then logging into opportunity, COIN will do better than both existing active management products and passive index investing. And the good part is you are going to reward the manager only when he delivers performance. Friends, COIN is our new PMS scheme rolling off in January. It's a product which gets its name from two words: containerization and invert. Clearly, we are going to pack this product with a very well-defined investment universe, which is the Nifty. We'll be investing within the Nifty at all times, and importantly, we will choose what we want to invest and where we don't want to invest, and we will always invert rather than just buy the index. This is the first time where we are going to create a product within an index with a philosophy which is built around the principles of containerization and inverting. We would like to reduce stupidity and errors by following this approach and keep the investor within a very well defined stock universe. How is this universe developed? This universe is developed through a very careful stock selection process. Firstly, we take the Nifty and we remove quite a few state-owned companies which are not value creators over a consistent period of time. Several of these companies go away. Next, by doing that, we reduce the universe from 50 to 41 stocks. Then, we remove companies with very high leverage, typically debt equity more than 0.5. And by doing that, this universe further shrinks to just 32 stocks. And then we remove the banks with higher gross NPA of more than 4% historically. The year for reference would be FY20, and by doing that, we further reduce the stock universe to 30 stocks. Lastly, we apply the principle of ROE of 12% and below for more than 3 years in the last 10 years. By doing that, from FY 2011 to FY 2020, we further reduce the stock universe to just 28 stocks. So effectively, as things stand, 28 stocks in the Nifty qualify for the COIN universe. By doing this, we believe that we will avoid stupidity like India Bulls or Yes Bank in the future and remove the value destroying businesses. At the same time, we will avoid businesses with high debt. We will also avoid banks which have high gross NPAs. So Effectively, we are going to reduce this universe into a very high quality universe and containerize the product within this universe. This, we believe, if done correctly and invested carefully, cautiously, where buying opportunities are not missed, an element of waiting is done sensibly, those portfolios will significantly generate alpha and probably even beat the benchmark by a distance. That in essence is how we have curated the stock universe, and it would be as good, if not better, than several existing product options. Let me list a few. Firstly, the balanced funds. We believe that having such a well-defined portfolio will do much better than the balanced funds. It will also do better than the asset allocation funds for the simple reason that we will also be adopting a principle of valuation driven position building, which would effectively perform far better than asset allocation products. We also think that this will do better than the large cap funds because it is strictly large cap and it does not try to include any other type of stocks into the portfolio just to generate returns. So it will be more true to label than even the existing large cap funds where you do have mid cap stocks getting in. It is rigid in the investment universe, but it also provides safety strictly from the rigidity that we follow. So by curating a product based on the principles of inverting, where we eliminate the stupidity, and containerizing, where we restrict the universe to just 28 stocks, we believe that we will be able to build a very robust portfolio as and when opportunities come before us. Yes, there will be an element of waiting, but it's worth waiting just to get our positions right priced and right sized. So that in essence is what COIN is all about, and that is how it would be different from all the other existing large cap options for you. We gave you how we do the stock selection. Now let us see how these stack up in terms of profitability and price risk. If you look at how this 28 stock portfolio has done historically in terms of ROE, you will see that the ROE has always been in high 20s. And the second point which you are seeing is that the eliminated universe has had a very inconsistent ROE. So by eliminating and inverting, we are going to eliminate the stocks which have had a history of poor ROE and focusing just on the stocks which have had a better ROE. The other point is with respect to the price risk, because the price movement of the selected universe is far less volatile, while the price movement of the eliminated universe has been far more volatile. So the way this stock selection has happened, it gives you a stock universe of high profitability and low price volatility, which is ideal. And effectively, it also means that because of the low price volatility, whenever the stock comes down, buying them is also a simpler decision. So you don't have to really worry too much that there will be too much volatility or there will be more volatility than the portfolio can handle. So that in essence is what makes this containerization a very good idea to be followed long into the future. If you look at the capital structure of these companies, you will find some very interesting findings. Firstly, the selected universe has a dividend payout of 36% roughly, while the other part, the eliminated universe, had only a dividend payout ratio of 14%, which means that we are selecting companies which don't need capital, which are returning capital aggressively to shareholders. Also, the eliminated universe has a debt equity of 1.2, while the selected universe has a debt equity of only 0.2. So the risk of leverage is also lower in the selected universe. So the capital structure of COIN is going to have only the companies which have high payout and very low leverage. Effectively, the structuring of the product itself creates a very conducive setting for a nice and comfortable investment journey. Let me show you one stock from the eliminated universe. While this may be a great value stock, it's still not going to generate consistent returns over time. It's going to show a lot of cyclical swings. This is NTPC, and if you look at how it has been a consistent underperformer to the Nifty on a 3-year rolling basis over the last 10 years, you will know how it has contributed to the volatility in several of your large cap fund portfolios. If the fund has underperformed the Nifty and it is a large cap fund, you will see that there will be a high ownership of this stock. Now, for people who do not want such volatility in their portfolios, it is only sensible that you don't include these kind of stocks, leave them in the eliminated universe and stick to only stocks which suit the investor. So effectively, that is what COIN does. It inverts and eliminates stock like these, which could lead to negative returns for significant periods of time and well underperform the benchmark. So that is essentially what we are doing, and I just gave you a sample of how we would leave out a stock and the reasons for which we are doing that. Now to the portfolio management approach. I talked to you in extensive detail about the stock selection and the filters that we would use. Now to the portfolio management approach and how the decision making journal will work. Firstly, there will be a model portfolio which we build with the desired weightage from within our stock universe. Second, stocks which are available at attractive valuations will be bought as and when they present the right valuation to us. So we will buy them immediately if we get them, or as and when they come to our zone, we would buy them. Then stocks where the valuation is not attractive, the stocks will be bought gradually, and every market correction will be used to add that stock so that we are able to size up our position at valuations which we like. So there will be a patient waiting approach, and we will be building these positions as the valuation comes within our zone. The excess cash, you know that the money will be available with us. Some money will always be in excess because we will not be able to invest them immediately. That will be parked in a mix of liquid funds, gold funds, which are ETFs basically, and we would from time to time move the money into equity as and when opportunity presents itself. So that is how the decision making journal would work. We also have the option of using these investments as return generating investments during the times when equity is not in our favor. So it's not that we're not going to make any returns, we would make some returns, and those base returns would come from these two choices. Effectively, this is the decision making journal which we will be applying for the portfolio management of COIN. We believe that we would be able to create very good portfolios which will deliver superior returns to 4 types of product options: balanced funds, asset allocation funds, large cap funds, and Nifty ETFs. We believe that all 4 are going to be open to outperformance in this model which COIN will adopt, and we will endeavor to do that. Now to the most important part, because when you curate a product, the cost is something that bothers a whole lot of customers. The first thing we decided in this product is that there would be no entry or exit load. So it's not a product where there's any cost to get in or get out. There would be no fixed fee as well. So the fixed fee is 0, which is cheaper than any existing mutual fund product in the large cap space. And then, how do we really remunerate ourselves? The first 6% returns are yours. The hurdle rate would be 6%, and above 6%, whatever profits we make, we would be entitled to a 20% of the incremental profits. There would also be a higher watermark for performance fees. The minimum investment would be 50 lakhs, which is the mandated minimum as per SEBI guidelines prevailing now for PMS. But there would be applicability of brokerage paid to stockbrokers to buy these stocks and custodial charges paid to the custodian of the scheme. So those charges will be borne by you irrespective of the returns generated by the portfolio, because those are essentially charges for services rendered towards curation and maintenance of the portfolio. So that in essence is COIN. The pricing is better than any product in the industry. It's favoring the investor. It also favors the fund manager if we deliver superior performance, and it's a product where there is ample scope for us to use this model of containerization and inverting, the two principles which are the centerpiece of COIN and the bedrock on which the product is created, to create outlier returns for you over extended periods of time at a very reasonable cost to you. So that in essence is COIN. We're very happy to present this to you, and we'll be happy to engage with you on any discussions or clarifications which you would like to have with us. Our entire team is available to talk to you about this product and its future and how it's best suited to you. Thank you very much for watching this video. We look forward to having you on board in COIN towards a very peaceful and profitable investment journey. Thank you.